Coming to you live from downtown Detroit, this is Benzinga's PreMarket Prep with your host, Joel Elconin.
This is a volatile puppy here, isn't it?
And Dennis Thick.
I'm bidding a penny. I will buy the stock for a penny.
With everything you need to start your trading day.
Good morning, everybody. Welcome to this Thursday edition of Benzinga's Pre-Market Prep. Spencer Israel here with Joel Elconin and Dennis Stick on the show today. Man, do we have a lot of news. We've got earnings, we've got Costco, we have Kroger, we have some other ones. We have a big M&A deal in the biotech space, Cigna buying Express Scripts. We have numbers also from L Brands and Win. And we have two guests today. First up is Marc Chaikin at 8:15 and Larry McDonald from the Bear Traps report at 8:35. So a lot to get to today. Joel, how are we doing in the S&Ps?
Wow, Spencer, you just ripped through that intro, and there's going to be no tangents today. It's going to be covering the news and getting everything done. S&Ps are up 7 points. Folks, we got a rollover going. This June is still the main contract. That's ESM18 on your platform. I'm still following the March. There's still pretty good volume in it, but just remember, this is a rollover, so you do see, some choppiness. So, but we're up 7, high 33.50. That's right up against Tuesday's high at 34.50. So that's the bogey on the upside. On the downside, low is 27.20 even. Didn't have anything there, but you do have a double close at 27.24 area, and that's just below mid-range. So that will be your intraday support. Bitcoin trading in the red, more regulatory concerns. Back under 10,000, 9,200 and 9,863. That's down 7.5%. Crude down 3 cents at 61.12. Gold in the red by 210 at 13.25.5. And silver down a few pennies here at 16.47. So Dennis, this is your fourth day back after vacation. Have you found your trading groove yet?
Yeah, I'm in the groove again. I'm feeling it now. So obviously the little dinner debacle, we'll call it dinner gate there, where I got picked off on a bunch of orders wasn't helpful, but that was just stupidity. It wasn't really anything to do with bad feel and bad calls. It was just leaving orders out there, not managing them. So I deserved that. But that being said, feeling a little bit more here now, although I'm feeling a cold here too. So excuse my voice here today. I haven't been sick in like a year, Joel. I was bragging to my wife about it. I guess you can't do that when you start bragging about not being sick. Karma's going to get you or something.
Yeah. All right. So we got some green here. We have an ADP at 8:30, right? So that could shake things up a little bit,
at 8:15
right?
Or 8:30?
8:15, Brentster? Right.
Oh, that was ADP. We did that yesterday.
Okay.
That's what
initial jobless claims. That's right. That's what I was saying. Okay. Yeah.
ADP is usually at 8:15.
Right.
So yeah, you're right. That was yesterday. Goldfish memory here. Goldfish memory for Joel too, apparently.
And that, is just a prelude to, the jobs number tomorrow. And that, that's what has been moving the market. So We'll see. We got a little bit of head start on the long side, but little bit of a surprising merger this morning. Spencer, who's buying who?
Cigna, CI, buying Express Scripts, ticker ESRX, for $67 billion. It comes out to $48.75 a share in cash, and then the ratio 0.2434 shares of stock in the new combined company. So Cigna,
this one is out of the blue. I mean, there was rumors last year on ESRX. But this is, nobody got the memo on this one because the stock's actually trading down $2 yesterday. So they kept this one very quiet. We always joke a lot of times you'll see a stock trading up the day before. It's like, who got the memo? Absolutely nobody on this one. It's trading up 12 points here in the pre-market. Is it all stock deal? Is there some cash or it's all stock?
It's stock and cash.
Okay. How much cash?
It's $48.75.
$48.75 in cash, and then the rest is going to be in stock. Okay. So CI down 5%, ESRX trading up, or actually, ESRX up 17% here now. So nice lift here for ESRX shareholders. I guess you might as well look at the leader now, who is going to be CI. Break down the technicals on this one, Joel. They're not liking the premium that they're paying as the stock is trading down 10 points.
Yeah, not at all. And boy, what a time to be doing a deal here as your stock is in the gutter after trading up to what 227.13 just at the end of January. Pre-market low comes in at 182.01. So people they want out. They want out of Cigna here. They don't like them doing this deal. And 182.01, we've got a couple buck bounce off that. So we will keep an eye on that level. According to my monthly charts here, your October low was 183.08. But if they really want to jam it, 180.04 was your September low last year. So there's a couple levels. We are a couple bucks off the pre-market low.
Let's jump over to a few other stocks on the list. So you got mergers, but you had a ton of earnings reports last night. This one's interesting. Costco was trading up on the initial report, and I was looking at the report, and on an adjusted basis, I saw a beat on the top and a beat on the bottom. And everybody else must have saw the same thing because the stock was trading up $6. Then on CNBC, they announced that they missed, and the stock just collapsed. This is because CNBC is always late to report it, so they report like 5 minutes later, and they often get the CNBC pop or whatever it is. But because they say they missed, I'm like, they missed. I'm like, I saw they beat, and they said they missed, and then the stock just absolutely collapsed. It lost all 6 points in the next 5 minutes because CNBC said they missed. On an adjusted basis, Spencer, do you have them beating? Because that's what I have.
On an adjusted basis, they missed. On a non-adjusted basis, they beat. That's the confusion. The adjusted was $1.42 versus $1.46. So the adjusted is where they missed.
Anyways, well, I saw the beat. Market saw the beat. Whatever they said, so maybe CNBC did get it right here, and everybody else got it wrong.
Sales also was a miss too. Sales.
It was up $6 on that report. It was trading 193, and my numbers said that they beat too. So I don't know. I guess I didn't look into it deep enough here either. But anyways, as soon as CNBC said they missed, the stock collapsed. So I guess either CNBC was really right really right here because stock is now trading in the red here as well. So I don't know what I was looking at or what the rest of the world was looking at, but CNBC said they missed and the stock collapsed.
And kind of in no man's land here. You had a nice rally in the stock off the February low, 176, got to 195. Now you're trading in the red here by 79 cents, which isn't a whole lot. So I'll make the level of control here that close at 187.36. You get above that, then maybe make a run at yesterday's high of 189.75. Coming back on the downside yet. We haven't even seen yesterday's low of 184.78. So I let this thing ping pong around, in yesterday's range. But until it gets green and stay green, then probably be a little favoring the short side a little bit.
I'm just trying. I'm still confused here because my initial numbers were $1.59 versus $1.49, and everybody else says it's $1.42. So I guess you had to consider those adjustments or something. But why did the market have it up $6? So I can read it wrong, but I wasn't even trading it. But everybody else read it wrong too.
Well,
the whole world read that number wrong, or did they initially come out with something and then the adjusted numbers came out after?
They did say that comps were up 8.4%, which is.
I had comps up 10.5% versus 8% estimates.
What? All right. You know what? Sometimes these releases can be confusing.
I'm wondering if they came out on the initial releases and then adjusted numbers came out after, and that's why I got killed. Because it was up $6 on the report. So it's one thing if I read it wrong, but I'm not even trading it. But the whole world read it wrong. Did you see it trading up $6, Joel? I didn't make that up. It was up at 193.
No, you didn't.
They were loving the report.
You never make
I was in shock when CNBC came on and said they missed. I watched the stock collapse 2 points in 10 seconds. And I'm like, what did I miss here? I'm like, I see a beat. So I'm looking here. I'm trying to find, and we've got John Dodson saying that 142 versus 146 here too. There's a lot of numbers, and I didn't dig into the report. I was just looking at the headlines there. But the initial headline was $1.59 versus $1.49. So I'm wondering if they just reported, then the adjusted number came out a little bit later, and that's why they killed it. But maybe it's just coincidence that CNBC said at the exact same time.
Wait, I want to say you had comps at 10.8%, right? That was net. That was net sales. That's a different
10.5. Yeah, sales are up 10.5.
Man, okay. Well, so comps refers to stores that are at least a year old. It doesn't refer to all their stores. It refers to stores that are at least a year old from the year over year. So those could be two different numbers. But this is confusing, I have to say.
It was confusing because the stock was up $6 originally on it. So you could see it on the chart in Joel showing you right now. It was a huge lift.
Yeah, it did. It did. And you know what? Probably caught some people there, Dennis, because
Sure.
over 300,000 shares traded in that bracket. So, I mean,
caught everyone. The
Yeah.
thing wasn't even thinking about going down until CNBC said they missed.
Wow. I mean,
I was like, did CNBC just misreport it? But then everybody else is jumping on that, and they're saying, so I'm wondering the adjusted numbers. That was the most confusing thing because original numbers of hit the wire were $1.59 versus $1.49, and maybe those adjustments came in when you start reading the fine print. But it was impressive that the stock popped $6 and then gave her all back. So wicked moves here, regardless for Costco. I'm glad I didn't buy it on those numbers.
You know what? John Dotson kind of wrapped things up here for you, Dennis. Algo's traded off the headlines, and they jammed it, right?
I was looking at trading it off the headlines. I did not trade it again because it popped so quickly, but that's a crazy move.
It does say in the release, reported net income from the quarter was $1.59 per diluted share.
Yeah.
Right.
The initial headline that hit the wire was
right.
$1.59. That looks like a 10-cent beat.
Can we move on? You guys are making me hungry.
Just surprising. So you can see how confusing. You have so many headline traders and so many, high frequency traders that are trading right off the headlines. And it did initially cross as a beat, and that's why you had the big pop. And then when you look into the fine print, it wasn't a beat, and that's why it dropped. So it just shows you there's good opportunity sometimes when those headlines aren't exactly 100% accurate.
And just another thing that we kind of talk about, with the pre-market and after hours trading, sometimes, initiating a position in it can be a little bit crazy. But, if you had any kind of target, because in Costco, on the dailies, I mean, you got to, let's see here. I always like to see if there's coordination. Your pre-market high was 193.68. Let's go to our dailies here. 193.76. That was your high on February 28th. So, if you're trading something like that and you have a target or you have a stock option position in it, there's some good opportunity. If you were trying to buy this thing, then you probably got clobbered. But we'll see. I mean, it's confusing, and we always talk about trading the news and the earnings reports, and it's difficult. And with algos, it's even more difficult, as you can see here in this chart at Costco.
And I was just talking to Brent. He did say, and he's one of the people that are posting our headlines to Pro. After the bell, there was math involved here because of the tax reform.
Okay.
So that.
But did you see the 159 I was talking about too initially?
Yeah. That's what's in the That's what's in the release. That's what the release says. It says $1.59. So I don't blame you for that. But there was math.
So it was confusing, and you had to break down the math. So and again, if you're trading on those initial headline numbers, just be careful, because sometimes when you break into the details, they're not as good as would predict there. So, John, ththere was $1.59 reported. I saw it on multiple wires, and obviously the adjusted number was different. So, good props to CNBC, because they were the ones that first reported that, because, or at least first were bringing it to everyone's attention, because it was up $6 before CNBC said they missed. So, jump over. Let's move on here to the other stocks that we're reporting here. We had Kroger, we had AEO, we had Burlington Coat Factory. We've had a lot of stocks here this morning. Want to go Krogering?
Yeah, let's do Kroger real fast before we go to Marc Chaikin. So Kroger Q4 adjusted EPS 63 cents is in line with the estimate. Sales $31 billion versus a $30.8 billion estimate. Fiscal year EPS guidance coming in line.
Not good enough. Stock got hit ahead of this report. It's getting hit here again. I mean, this move that this thing had at the beginning of the year, everybody's worried that Amazon's going to eat their lunch. We got Whole Foods coming. Kroger gets absolutely slaughtered back in the summer. Trades down under $20, and then they just decide for whatever reason to buy every laggard in the whole world in November. Goes from $20 to $32. $20 to $32. So crazy move. You're talking about 60% move in Kroger. Now it's given some of this back. Now it's looking more realistic to me. I mean, I don't see any reason to own this thing when it was over 30. Now it's 24. You still got a lot of issues there, though. There's a lot of issues going on. You have an ugly Head & Shoulders that just resolved itself. I mean, if you were just completely ignoring the fundamentals here, look at this long-term Head & Shoulders. And I'm talking about the left shoulder at $28, the head up at 31.5, the right shoulder formed almost identically at 28, and now the collapse. I mean, this textbook technical pattern here.
All right, top pre-market low here in Kroger comes in at 24.02, getting a little bit of a bounce, not a whole lot. Gap fill here, Dennis. You had a gap up. This might have been on the last earnings report. You had a gap between 24.40 and 25.53. You did hit that in the pre-market. I'd be a buyer down here. I'd be a buyer 24 even to 24.40. You're also under your 50% retracement a little bit. So I'm not talking about, be married to this thing or anything, but it's a nice gap fill, down big percentage. I don't know. I would not. This is one I would not be shorting in the hole.
All right, 8:15. We're taking a quick break and grab our first guest of the day, Marc Chaikin. Will be right back. Welcome back, everyone, to PreMarket Prep. Spencer Israel, Joel Elconin, and Dennis Dick, and we are on now with Marc Chaikin from Chaikin Analytics. How's it going today, Marc?
It's great. I'm in sunny San Diego, so I missed that whole mini storm in Philadelphia.
Lucky you. I heard my parents were getting clobbered, so glad I'm not there. But Marc, what is on your radar this morning? We were talking the Cigna Express Scripts deal. We were talking Kroger. We're talking Costco. What's on your radar?
Well, I think the Express Scripts deal, and then the one earlier in the week with XL, insurance company getting a major bid, is what we expected after the tax cut. We thought there'd be a pickup in corporate buybacks, obviously some dividend increases, and M&A activity picking up. And I think this is, the start of the wave of M&A activity that will help the market in the long run. Short run, we're seeing backing and filling of the tariff proposals that President Trump threw into the mix last week were a wild card that none of us really expected to come that quickly, and the market's trying to digest that.
Marc, we were just talking about the Costco report and how the release was confusing. The release said one EPS number. They ended up being the adjusted number was different. It ended up being a miss rather than a beat. Are you reading earnings release reports? Like, how do you get your earnings information?
Well, I'm looking more at the market's reaction to the earnings releases because you've got a combination of guidance. Obviously, guidance has a positive bent because of the impacts of the tax increase. The top line sort of headline to me is that 25% of the companies in the S&P 500, which is a record number, have reported positive guidance in this earnings season that just ended. I think you have a lot of stocks where on the surface it looks like a positive surprise. So I'm looking really at the reaction to earnings rather than what the numbers actually say, because the market is very sensitive to guidance right now.
But how much of that positive guidance to you is just due to the tax reform?
I'd say 40%, but I think 60% is a strong economy. And that's something that the market is reflecting. I think without this, I'll call it a wacky tariff proposal, but you can call it what you want. Without the uncertainties that surround this tariff proposal that's a moving target with changing political influences, pushing it one way and pushing it the other. I think without that, we'd be moving back up toward new highs, because whereas initially we were looking for W-shaped bottom, now it's clearly a V-shaped bottom. Now it's clearly some form of a W, and tariffs are the wild card. But I'll tell you this, the reason I'm in San Diego is that we're at the John Malden SIC conference, and you've got some really smart speakers. I heard Neil Ferguson speak yesterday. George Gilder, the futurist, is speaking, and the attendees are a cut above. They're very sophisticated, very savvy, either businessmen or professional investors. Every speaker is bearish here, every one, from David Rosenberg at Gluskin Sheff to economists, to people who are looking at the long view, the short view.
Well, I was going to say bearish.
They're all negative.
Bearish in what way?
Well, they don't find a way to see upside in a positive way for the market. They all see everything from disinflation, which is Lacey Hunt, who's going to be speaking tomorrow, to seeing the world as half full. The glass is half full. I see the half empty, rather. I see the glass as half full. I think with everything that we've weathered here and the madness of the blow up of the ETN and now the tariff issues to deal with, they just can't see through the haze. And we're here exhibiting Chaikin Analytics, and I got to tell you, the attendees come to us as if we're an island in the storm, saying, finally someone who's not bearish.
Mark, what do you?
So I think.
I just want to expand on that point. What do you make of that when you are seeing everybody bearish? Like, is that just a contrarian signal? If everybody thinks we're going to top out, that it's naturally not going to happen?
I do, and especially this isn't just some guy looking for a headline on Benziger or CNBC. These are very solid, substantial economists and thinkers, and globalists. So I think one of the points that people are missing is they keep talking about valuations being too high. The bull market is long in the tooth. These are just sort of standard benchmarks. They're dealing with the Shiller Cape-PE ratio, perhaps the worst valuation method ever foisted on by an economist on the American people. And so I think if you look at the market, the uptrend is intact. People need to identify the stocks that are doing well. So if you look at semiconductors, can you find any fault with what Micron is doing? It's unbelievable.
I mean,
now AMAT has joined the party. There's money to be made here. The banks are going to do well. The brokerage firms are going to do well.
Like, the argument on the other side is when you look at Micron and Applied Materials and a lot of these older semiconductor stocks, is that these stocks are still significantly off the highs that they made 18 years ago. So if you look at it from that perspective, instead of just looking at the most recent run, you say, a lot of people, and including myself, will say, Micron was $10 a year and a half ago or 2 years ago. Now it's 50. It seems way overdone. But maybe the problem was it was just way overdone at 10. It should have never been there. I mean, it's cyclical, and now obviously the tide has turned for them, fundamentally speaking, and the stock is outperforming because of that. I mean, when you look at it from a valuation perspective, if you are analyzing it, from the current earnings, it still looks cheap.
Yeah, if you think of it as a cyclical stock, then you have to be suspicious of where it's trading. But there's a theory that semiconductors are no longer cyclical because of the change in the Internet of Things and everything being wired. Even mining for Bitcoin has created demand for computer power and so forth. So there are changes. That's why NVIDIA is suddenly starting to look a little more attractive in the work that we do at Chaikin Analytics. The power gauge actually turned bullish finally for NVIDIA. I wish it had turned bullish a year ago because it was the best performing stock on the New York Stock Exchange last year. But there's something to be said for the fact that money still needs to go somewhere. I can't see it going into bonds. I mean, look what's happening to the euro this morning. The dollar is going to weaken. I don't see bonds doing anything but going down as yields go up. But the market is spooked by an awful lot of things, and part of it is that the people are looking at the wrong history lesson. They're saying long in the tooth, high valuations, and they're ignoring the best corporate earnings growth you could ever imagine, spurred by tax cuts and an expanding economy.
We're on the line with Marc Chaikin of Chaikin Analytics. Someone coming out of here, the Google chat, George. He says the haze is trillions in debt issued near 0%. How can you not be leery when Fed policy has blown up the market every few years?
Well, Fed policy saved us from a major disaster in 2009. If you can't give credit to Janet Yellen and what she did to pull us back from the precipice, and the reality is that since 2009, the market has gone up every time interest rates have gone up. When the market has gone down in the last 10 years, it's when interest rates have been going down. So we want to see interest rates rising. In this case, they're rising for the right reason. They're rising because corporate earnings are going up, and we don't have a lot of inflation. We had one data point of inflation of hourly wages going up 0.39% on February 2nd, and that sort of undid the market and then triggered that whole surprise of blow up of the ETN tied to low vol. And now, we haven't seen another data point that suggests that inflation is out of control. I don't think the Fed has blown up the market, with all deference to George. I think what's happened is the Fed is trying to do the right thing, unwind the balance sheet in a methodical way, be data-driven. Powell, in spite of his misstep, I think we've got a new phrase in the world. Hopefully you don't see it again. The market was powelled a week ago Tuesday from an off-the-cuff comment that he made. But the Fed's doing the right thing to me. They're maybe doing it a little late. They could have been unwinding the balance sheet somewhat earlier. But Fed unwinding the balance sheet, gradual increase in interest rates, reflecting a strong economy, gives them the room to maneuver if we get a recession in late 19 or early 20. See, that's another thing that I'm hearing at this conference. And I think if I could give our listeners a message, it would be, you may be right, but when? There are a lot of people. I had some people who are advisors who have previously gone to this conference, which gives you access to some of the finest minds in Wall Street and in the world one-on-one, like Neil Ferguson, who was a joy to listen to. He talked about networking and the monopoly that Google, Apple, Amazon, and Facebook have on people. But if you have a theory and you're going to be right eventually, it's like they used to say about a guy named Bob Prechter, who had a big influence in the 80s on the market. I'm sure he's going to be right. Like a stop clock, he'll be right twice a day. So the question is when. You can lose a lot of money and miss out on a lot of opportunity if you're sitting on the sidelines waiting for the world to come to an end. That's why technical analysis plays such a big role in what I do. You got to know what the economic backdrop is, but also factor in the technicals.
The one way I've always considered, I'm 41 years old, so, I'm fairly fully invested. I've got some cash sitting always just for opportunities, and, but I've always said, if you stay long the market, then, or if you, let's just say the scenario where you sell into cash. And, this is a scenario that a lot of people had, 2007, 2008, 2009. A lot of people liquidated into those lows. Now they watch the S&P go from 666 up to 2,500. And they're sitting there kind of puking their guts out watching it go as they're, never really got back in. And that's maybe the biggest issue here is you are getting worse off than everyone else. But if you stay fully invested, you're at least staying the same as everybody else to a certain extent. I mean, if we're talking Wall Street, not Main Street, because a lot of Main Street doesn't have stocks. But if you're staying, fully invested, if the world ends, well, it ends for everybody. So, that's everybody's in trouble, even the people who aren't invested. But if the world keeps going and the stocks keep going and you're missing out, you're just missing out on all this money and all this, it's obviously could eventually lead to inflation. You're just getting worse off than everybody else. That's the argument I give myself whenever I think the world's going to end. I say, stay the course, because if it does end, it ends for everyone, even the people who, are not invested and the people who are invested. But if it keeps going up, then you're participating in that. So the worst case scenario is to go full cash. It keeps going up without you, and then you're worse off than everybody else.
I think that's the right attitude to take. Now, we would all like to have the magic indicator that tells us to get out at the top. There are going to be signs that tell you to pare back. I mean, one way to discipline yourself is, if stocks spike up on an earnings report and you've already had a big gain in them. Always nice to take some money off the table. And then at least you've got some ammunition to get back into the fight if you get a wild, volatile decline like we had 2 weeks ago. But here again, it's hard to pull the trigger and know when to get back in. So I know a lot of people who, sort of looked at that volatility and said, whoa, Nelly, I'm not buying into that. Well, people who did buy into that are very happy. Whether you bought into Boeing or JP Morgan or AbbVie or Michael Kors, any of the strong power gauge rated stocks on Chaikin, you did pretty well. Now, you don't put all your money, you don't put all your chips into the pot at that one point in time, but we told people buy a third, put a third of your cash to work. That proved to be a good point in time. Now, you've got another sort of sideways market where you've got to be looking pullbacks and buying opportunity. I'll point out with Express Scripts, and I think that's a good lesson for everybody. Here's a stock that's gone through waves of emotional sort of up and down moves in the last 3 years, because our model has basically been bullish on Express Scripts, but there have been more pitfalls along the way where there were potential lawsuits where they were going to lose Anthem Health as a big, by a big partner in the pharmacy benefit area, where there was news out of Washington about cutting drug prices and how that was going to affect the big wholesalers and so forth. And guess what? Even before the bid, the stock was making a new 52-week high. So even when you're in the right stocks, the market has a way of encouraging you to do the wrong thing. So you really have to have a plan and stay the course. And the plan in general should be fully invested, but there will be warning signs. If we're going to get a bear market, it's going to be associated with some sort of a recession. And 50 years into my career, I finally found four economic indicators that reliably predict recessions. I wish I had known about them 30 years ago, but I was so tied to technicals that if you said, here's some economic indicators that can help you, I almost laughed you off. But there will be some warning signs, and then you can go 40% in cash or 50%. Going 100% anything except 100% in a bull market is a mistake. So I really agree with what you said there. And it's just a question of how you manage it on a day-to-day basis. Part of the answer to the problem is turn off the sound. You're watching CNBC, people get on the show by making outlandish comments. So, watch the stock prices, but turn off the sound.
We've been on the line with Marc Chaikin from Chaikin Analytics. Marc, thank you so much for the time today. We'll talk to you again next week.
Spencer, I'm looking forward to it. Enjoy.
All right, have a good one. 8:32 now. Where are we at? 8:33. Where are we at in imbalances? Anything of note there, Dennis? Did you get a chance to look?
Square hasn't posted yet, so I was waiting for the SQ imbalance, but it's just zero. So designated market maker is obviously not just posted it yet. Maybe he's in the bathroom, but waiting for that one to post. But looking here, I thought they were posted automatically, but sometimes they don't come out right at 8:30. So switch the on switch there for the algo to post the imbalance, because obviously it's all done by algorithmically here now. Twitter, 55,000 to buy. That's significant. Twitter had a hell of a day yesterday. A lot of stocks that we talked about. If you rewind the tape and listen to what I said yesterday, I said to be buying stocks that were strong. So on the dip yesterday, I was saying the stocks you want to buy are the stocks that were strong the day before. Those were all the stocks that blast off. Twitter had a double top of 35. It broke out from that, but Square was another one, opened almost at the low, straight up. You had a lot of other tech stocks like Ciena, which had a great day on earnings. It opened up right at the low. There was a lot of opportunity if you were buying the strong stocks from the day before. Those were the ones that really catapulted us. It's been tech. The tech stocks have just been the stocks that have been leading us. They continue to lead us here. So despite the sell balance that I keep saying is in Square every morning, it seems to open at the low and it keeps rallying and going up. So it's been an opportunity to buy that almost every single time.
We had jobless claims plus 21,000. S&Ps have backed off the high. 33.50 is our high. That's buck below Tuesday's high. Still hanging out at 27.30. Mid-range on the session. I'll be keeping an eye on 27.27 perhaps if you're looking for a lower risk long entry. Let's see here. We have 10 seconds here. You just want to go to Mr. McDonald.
Let's go to Larry McDonald now. He is the former head of macro strategy at SocGen. He is the founder of the Bear Traps Report. We'll be right back with Mr. McDonald. Welcome back, everyone, to PreMarket Prep. Spencer Israel, Joel Elconin, and Dennis Dick, and we are now on the line with Larry McDonald at Convert Bond on Twitter, founder of the Bear Traps Report. Larry, how's it going today?
Hey, Spencer.
Okay. I guess I haven't had you on in a while, Larry. So broadly speaking, give us your overall macro take on the market. We just on with our last guest who was saying he's at a conference out in San Diego and everyone there is bearish and he doesn't really see it. So broadly speaking, give us your macro view of where we're at right now.
Well, I'm more of a rates person than equities, but I use, our team, we use fixed income, whether it be rates with treasuries or high yield to try to signal equities. But first of all, what we're seeing in high yield is very disturbing. I mean, you've got 3 months LIBOR up near above 2%, and the J&K, the big ETFs, as well as what's called the high yield CDX, which institutions trade. High yield basically is like 5.9%. So the spread between a 3 month riskless transaction and yield to a junk bond is the tightest just about ever. So it's creating a lot of hemorrhaging. And so essentially what the Fed has pushed up the front end, viciously pushed up the front end with their 5 rate hikes, and also now forecasting 3 more for this year. And that's creating a lot of stress on the short-term bond markets, in which is starting to leak over to equities.
Let's talk about some of the commodities. Which are you favoring right now? Because you follow that space closely.
Well, we haven't been in the commodity space for a lot of years in terms of the softs. Softs are what are called agricultural commodities. But we wrote a report maybe 3 weeks ago about softs versus hards. Now, softs are agricultural commodities, and hards are copper and metals. And we think there's going to be a substantial mean reversion this year with the softs. They've been decimated. They're coming out of a 7-year bear market. And there's just so much money that went into risk parity and bonds and stocks that when stocks and bonds sell off together like they did in February, those things typically don't happen just once. Like we had a 2-week period in February where stocks and bonds sold off together. And that's one of the first times since you'd have to go back to the 70s and 80s and 90s, it was much more common. But from, say, 1996 to this year, you really never had stocks and bonds sell off together for more than 2 weeks, right? So we predict when something like that happens, it's a secular change, and we're probably going to have more periods where stocks and bonds sell off together. And when that happens, there's trillions of dollars in these two asset classes. It has to go somewhere, and it's going to go into soft commodities. So we have a number of not just ETFs but futures contracts that we'd like for clients for 2018.
Care to be more specific with regards to what types of softs?
Well, we say softs, your grains, in your agricultural space. So grains, ETFs like the DBA, which is a major ETF in the agricultural space. So companies like Mosaic, which use one of the largest suppliers of fertilizer. So we recommended Mosaic in a trade alert in early February, like February 8th or 9th. And we think companies like Mosaic are in a very unique position with this secular, not just a secular change that I've just been laying out, also from an El Nino weather pattern that's been happening in this hemisphere. You have a decent probability of a nice mean reversion positive year for agricultural just by itself. And so you really have a powerful secular move in a company that's been in a 7-year grisly bear market. And so Mosaic, MLS, we like the risk reward in that equity.
You mentioned earlier that you're watching rates. Obviously we have the Fed next week. Anything outlandish you expect out of that meeting?
Well, we recommended we started shorting treasuries in August, and then we were hit with 2 hurricanes. The whole President Trump's business council dismantled in early September. And that created, and then you had obviously missiles going over North Korea, missiles going over Japan. So those things created a real bid for bonds, and we were in some pain. So we were short right around 220 on 10, and we went down to 2%. We added to the short, and we recently started to take it off in early February, and we've gone long the TLT and the XLU utilities. And we just think that the positioning in rates has gone from extremely bullish in September to extreme bearishness for treasuries. And that positioning is just too crowded. So we for a very short-term trade, I think in maybe 1 to 2 months, we want to be long treasuries and utilities. And most importantly, the economic data, because of the vicious move up in, say, mortgage rates, the short end of the yield curve. Like I said, 3-month LIBOR has gone from 50 basis points to 2%. And there's trillions of dollars of loans in America that are tied to 3-month LIBOR, right? So when you have a move in 3-month LIBOR that's driven by the Fed rate hikes, that's going to create a refinancing problem for trillions of dollars of lending in America. This could create a little bit of a soft patch in the economic data in, say, the second quarter of this year. And that data will start coming in. That will probably put a bid into treasury. So we're short-term treasury bulls, but by the end of the year, early next year, we think we're going to be up on 10s at 3.75 to 4%.
Larry, thoughts on the tariff and potential trade war here? Cone obviously is gone here now. Market sells off 300 points on that news, bounces right back. So they basically shrug it off once again here. What are your thoughts here? Because this is significant. This is a significant event. It's showing a number of things. It's showing the chaos that is still coming out of the White House. But, a trade war here could have impacts for a number of industries. What are your thoughts here on Cone stepping down, the market shrugging off?
Well, we're in a period where we've had the best growth cycle in the global economy in probably 10 years. I mean, think about the IMF. For the IMF, for 6 consecutive years, underestimated global growth. By not just by like a little bit, by nearly almost 1% in some cases. So, they couldn't hit the side of the barn. And now the IMF, in the last 12 months, underestimated the growth. So in the past, they've gone the other way. They overestimated the growth for 7 years, and now they underestimated the growth cycle. So we have this beautiful growth cycle. Everybody got bought into it. Everybody was into buying emerging market equities, and everybody's been really pumped up. And now we have a crowded theater with a news headline that is creating a little bit of a denial phase. So the average investor in the global trade, not just global trade, but the global equity picture, is in a little bit of denial, right? They're holding on to, okay, Gary left, but Mnuchin softening the position, or Gary left, but the White House is going to make exceptions. But at the end of the day, you have to remember Michigan, Wisconsin, and Pennsylvania, and we were one of the few people in 2016 that predicted. Our team predicted the Trump win because we were looking at the data in the Rust Belt, and especially Michigan, Wisconsin, Pennsylvania, and he's going to play to this base. And these midterms, if he loses the midterms, right, the Republicans are plus 47 in the House, plus 47. That's a tiny margin. That means if you lose 25 seats or 24 seats, you lose the House. So Trump's going all in to try to keep the House, because if they lose the House, then they lose the control of the committees. And then you're going to see the Mueller investigation. If you think that the noise out of Mueller is loud now, what's it going to be like when the Democrats control every committee in Washington? So Trump knows this. He's going all in on the 2018 midterms, and the sledgehammer to go all in is trade, because that plays to his base, and that plays to why he won Michigan, Wisconsin, and Pennsylvania. So he's not going to soften up that much. We think the position is going to be much harder than the current expectation cycle.
A question coming out of the chat from Angie Baby. Larry, she's read your note and just wondering if you still like silver and the TBT.
Yeah, well, we covered the TBT. We sold the TBT in trade alerts in early and mid, I think February 14th, in trade alerts decline. We love silver, even though silver is a hard metal, but we don't put silver in the hard basket with copper and iron ore and the rest of them. But we love silver for this year because the gold silver ratio, if you look back, it's really topping out here. Gold has outperformed silver by a dramatic amount, and we think it's unsustainable up here. You have a situation with assets globally, like I said, in stocks and bonds, risk disparity, and that money, when you have any type of inflation worries, typically in a cycle like in 2010, lots of deficit spending in 2010. We had $1 trillion deficits 2010 and 11. Silver was up 145% 2010. I think it's 2010, and gold was only up 40%, 45. So we look for silver to dramatically outperform gold in the next 18 months.
Larry, last question here from our chat, and then we'll let you run. But going back to our conversation earlier, we had someone asked if you like the ETF MOO. Mary, Oscar.
Yeah, MOO. Let me look at it here. That was on our list. Yes, that's the Van Eck Ags. The one thing we were worried about with that ETF is we had it on the list, but it's the volume. So the volume, let me just double check. Yeah. So the problem with some of these ETFs, right? It might only trade like 35 to 40,000 shares in a day. So if you multiply that times $60, right? It's not a lot of capital. So if you're a small investor, fine. But if you're an institutional investor, you can't really play in the MOO. But yes, we like that. The MOO is something that we want to own this year.
All right. We've been on the line with Larry McDonald. He is many things. He's the New York Times best-selling author. He is founder of the Bear Traps Report. Larry, thank you so much for the time today. Appreciate it, and have a good one.
Thanks, Spencer. Thanks for all the work you guys do. Appreciate it.
Have a good one. 8:48. Anything interesting happening out there, Joel?
No, we're
nothing interesting.
Nothing. Absolutely. We have had a really tight range here. We're staying green by 7 points here. Just cautioning people on the rollover here. The front month contract now will be your June, and that's ESM18. I'm still keeping my levels on the March. Still the volume predominantly in the March, but the rollover is going over here over the next couple days. Dennis, let's go to you. We did do some earnings reports. Did we get to cover all of them?
It is just quiet out there, but no, let's go back to the earnings here just for a couple minutes there. Burlington Coat Factory. Let's jump into a few of these retailers that reported. BURL is obviously going the opposite direction of what we heard from raw stores yesterday. Raw stores got hit. BURL got hit in sympathy. People probably expecting that Burlington was going to disappoint. That is not the case. BURL trading up substantially here in the pre-market, up 8% here now. So if you're following raw stores lead, Burlington had none of it.
Burlington stores Q4 EPS $2.17 versus $2.10. Sales $1.937 versus $1.89 billion. So a beat on the Q4 numbers. Fiscal year 18 EPS guidance coming in well higher. I'm not positive if it compares because it was higher by like $1.50, so I'm not sure about that. But excluding the impact of the tax reform, the EPS guidance is still higher by about 30 cents for the fiscal year. They do see Q1 sales up about 10%, and Q1 EPS is also higher. So pretty much higher guidance across the board and strong sales.
That's a huge pop here for Burlington, and obviously everybody expected that they might disappoint. That's why it was down $6 yesterday at one point in time ahead of their earnings report. This is now going to challenge the all-time high. I mean, you're looking at a stock that is within like 2% of its all-time high here right now. Incredible. It's the discount retailers. Some of them have really held on a lot better than anything else. And I know you go to those Burlington stores, they're big stores, but they sell a lot of stuff because they sell stuff just dirt cheap. I'm actually a fan. You go there into the Burlington Coat Factory. I guess they don't call it Coat Factory anymore, but there's all, just you go in there and there's brand names at discount prices. And you know how I always want a deal. It's the trader in me. I want a deal, but you can get brand names at discount prices.
I have a question about this. So I try to put, these individual companies, and I try to, find a theme. So yesterday, Dollar Tree reported, right? And it wasn't good. Dollar Tree discount retail outlet, I guess you can call it, right?
Yep.
Right. They missed, not good numbers. So you would think Burlington, another discount retailer, kind of thought the same thing. But
raw stores missed
and
too.
Raw Store,
you had two discount retailers.
So this is just bucking the trend.
Yeah. And maybe expectations what were the numbers? Give us the numbers here once again.
Wait, for Burlington?
Yeah.
The EPS was $2.17 versus $2.10. Sales $1.93 versus $1.89 billion.
So it's not a huge beat, but because your expectations, my expectations were probably lower now because we saw the Dollar Tree get annihilated. We saw the raw stores. Any beat was going to probably rally the stock. So it's all about, you got to look the day before it. It's all about expectations, and expectations quickly changed yesterday. When you see Dollar Tree get annihilated, you're like, oh man, Burlington's going to miss too. Market said they were going to miss because they sold Burlington off $5 ahead of the report. So expectations different now. Burlington beats good enough. Stock is up $9. You catch a few people short, people playing the sympathy. They're dead wrong. Market likes to punish the maximum amount of participants. And there you go. Stock's up $9.
Let's just take a look at the technicals. Your all-time high was made not too long ago here in January at 128.93. Got up there near the pre-market or the after hours. You got there was pre-market. You got all the way to 128.75, and now you've backed off into the 125 handle, 125.64. I won't go along. I might go on lunch, Dennis. I say the high of the day is in here in Burlington.
What's the high?
The high in the pre-market was 128.75. The all-time high is 128.93.
Yeah, coincides with that.
So I just think, and then finally someone after that high, they stepped down to 128.25. Then they're just bringing their offers down. They targeted 127 for the next two brackets, and now we're back under 126.
I'll tell you though, I'm not going to make the bet with you because it does coincide. Technically, that's a nice setup when the pre-market high coincides right around with the all-time high. But I'll tell you, if you were putting a gun to my head at 125 on this, I'd buy it in the nuts. If you were putting a gun to my head and said you got to buy it or sell it, I would be a buyer of Burlington. Why? Because I think you got a lot of people caught short yesterday that were banking this number was going to be bad, and those people are going to be scrambling for cover. They already are in the pre-market. That's why it's up $9. But a lot of times you see these things follow through, and it wouldn't surprise me if this thing did make all-time highs. But I'm not going to make the bet just simply because that's a nice technical setup when the pre-market high aligns with the all-time high.
And you know what I think? I think all these people that got crushed yesterday and said, "Oh my gosh, I wish I would have sold ahead of the report." When it goes down,
but who really got crushed? I mean, it was down $3.
Okay.
Maybe. There's that argument. It's overhead supply. I get where you're going with it. There's an argument. That's why we have markets. It's an argument. I can argue both sides of this trade. Maybe that's why you shouldn't make the trade. When you can argue both sides and it's, there's catalysts either way, maybe you should make the trade. But I don't know. I got a feeling that this thing's going to challenge the all-time high again. I got a feeling we're going to be looking at this 128, 129 yet today. I almost want to make the lunch bet, but I just, for some reason, I'm not pulling the trigger.
Okay. All right. All right. DC1, stock picker, he's been pounding the table on Thor Industries here, trading up 7 sticks.
Wild yesterday.
Yeah. No.
Okay. Well, yesterday after the report. Okay. THO, give us the numbers.
Yep. Report Q2 GAAP EPS $1.51, sales of 1.79 billion versus 1.97 billion versus 1.93 billion. So I don't know if there was an EPS estimate, but they beat on the sales.
Give us the numbers, or give us the chart here from the after hours action, because this was absolutely lighting up my after hours filter. It was like all the other stocks and Thor. This one was all over the place last night.
All right, your dip down took you to 115.52.
Down $7.
And if you had been looking at the low of the move at 115.51, that was on March 2nd, you might have made a good purchase there. Now you've rebounded all the way. Your pre-market high is now taking it to 129.71. I mean, 130 just sticks out here to me. Even though you had a high at 28.91 and one at 31.56, I just like to see what happens at 130. After that, 131.56. But boy, big move in this one, taking out the low of the move and then rebounded.
Couple other stocks that reported earnings that we didn't get to yet. AEO, American Eagle Outfitters, reported earnings. Spencer, how'd they do?
AEO Q4 adjusted EPS 44 cents, which was in line. Sales 1.23 billion versus 1.21. Comps up 8%. Q1 EPS guidance coming in higher by about 3 cents, and they're also raising their quarterly dividend from 12.5 cents to 13.75 cents per share.
I used to always pair trade this years ago with Aeropostale, ARO, and we know ARO, I believe, went bankrupt. It's gone off the board there, so it's gone. And you kind of think like, okay, well, ARO can make it. How's this American Eagle Outfitters going to make it? I mean, it's been a surprising year for them, though. So it got down to $10, and you think eventually they're going to go the same way as ARO. Well, this has not been the case since November. The stock is basically almost doubled. So it's been an impressive move. That being said, if you go out to the monthly charts and look, you topped out in 2012, 2013 at 23.94, 22.50, 22.5. You're starting to get to a point where you're back at all those old all-time highs around $22. All kinds of people who were punished for the last 5 years saying, thank you, I finally got my money back. So I think it's going to be tough sledding from here. I can see this move up to 22, but beyond that, I think it's going to be difficult. So now you look at a risk-reward perspective. If I own this in my investment account, I think I would be ringing the register.
22.63. That was your high back in March of 2013. You are breaking out here a little bit, but still my key number for the day, yesterday's high at 20.83. We did sneak into the 21 handle off the report. So let's see, we hold above yesterday's high. Have a chance to challenge that pre-market high of, what did I say it was? 21.34. You want to cover a win real quick here, trading up 5 sticks?
Yeah, give us the news here, Spencer.
Wynn came out with, it wasn't quite earnings, but they did give like a quarterly update. So I guess we'll just read you the update. First off, they're raising their dividend from 50 cents to 75 cents per share. That's a quarterly dividend. Let me pull the chart up on the screen too. So they had that. They also had like a quarterly update. I'll give you that. Through February 28th, Las Vegas operation sales were down on a year-over-year basis. Wynn and Macau sales were up on a year-over-year basis. Wynn Palace sales were up on a year-over-year basis. And so I think it was just that was the update pretty much. They were giving an update on their three properties. Las Vegas operation sales down, Macau sales up, Palace sales up, dividend increased by a substantial amount.
Numbers not as bad as maybe some people were concerned that people are going to start boycotting going to win because of obviously the allegations against the founder. That hasn't really materialized here. Interesting charting though, like you caught everyone there, Joel. On this 160 was major support, and then you had the breakdown day back on February 2nd where it went down to 156, and everybody's like, "Oh, this is the breakdown. This is it." It reversed that day though, and you got to watch when they reverse on those same days because if you look at that 156, then it got up and it actually I believe closed above there. If we look, yes, it closed at 163, so it was actually the breakdown was a fake down. And then it even gave you another shot and retested again the next day, 158.66, did not make a new low. And since then, it's been straight up. So you caught a few people playing the breakdown that did not materialize. And now you got to break out. So 170, this thing been between 160 and 170 for basically a month. Now you're breaking out. So the only thing, it was a fake down on the breakdown side. Is this a fake out on the breakout side?
I have to, yeah. I mean, you did get a little bit of a pop here. The high of the pre-market sessions, 176.60, but you've leaked $3 off that, still up $5 on the session. Really no clear resistance until you get to close to the 180 level, 179.20 and 180.10. Those were some highs from February 7th and February 8th. And actually, those are the recovery highs from when the initial news come out. So still at a trading range, just not quite up at the upper end of the trading range. It's already 9:02, Spencer. How did you like to go over here?
I don't know. I want to run through a couple ratings. There wasn't a ton to speak of this morning, but there's a couple that caught my eye. Splunk caught an upgrade from Argus, hold to buy. Booking Holdings, the company formerly known as Priceline, BKNG, caught an upgrade. I think that is the first upgrade to the, whatever you want to call that, Booking Priceline. First upgrade to that company in how long? Since 2016.
Wow.
I think.
But look at the chart. I mean, I made fun of them for the name change, but it's worked. And here you are at all-time highs. BKNG, the old PCLN, is all-time highs here. That's impressive.
Right. So that caught an upgrade this morning. Who was that firm? That was Argus. So Argus upgrading Splunk and Booking. Those were the only two that caught my eye as far as ratings go. Yeah, not a lot to speak of there. In any upgrade or update in balances, Dennis, or nothing has changed really.
Baba 8 is 40,000 to sell. Twitter is 60,000 to buy. They are small today. General Electric small sell balance. The Square guy must be gone away. 5,300 to sell here in Square, so that is very small from what it's been. So GE small sell amount, 75,000 shares. Man, they're small today, though. I just don't see anything really material. Besides Twitter, 60,000 to buy, and Baba, 40,000 to sell. Those are the two standing out to me.
All right, that is going to do it for us today on the docket for tomorrow's show. We have a new guest, one that I know Joel is very excited about, Steve Sears. Joel, he wrote for Barron's for many years.
12 years.
Okay, he wrote for Barron's for 12 years. He's going to join the show tomorrow at 8:15. Then at 8:35, we have Chris Temple hopping on. He's with the National Investor. But if you want to catch any part of today's show again, you can do so on our podcast on iTunes, SoundCloud, and Stitcher, or just go to youtube.com/BenzingaTV and catch the show as it aired there. Thanks to all you who joined us today in our chats, both on YouTube and at premarket.benzinga.com. Thanks to our guests, Marc, Chaikin, and McDonald. Hope you all have a good rest of your day, and we will see you folks on Friday.